What's up, everyone? In today's video, we're exploring Warren Buffett's secret sauce for knowing when to sell stocks. Specifically, we'll break down the 3 key indicators Buffett watches to spot when one of his stocks has peaked and is about to start heading downward. These signs allow Buffett to get out before the crash and book big profits. By getting what Buffett looks for, you can get way better at spotting when your own stocks have hit their high point and are ready to head down. This allows you to cash out those stocks before they peak. Let's break down each of these signs one at a time so you can put them to use. The first indicator is insider selling. The first signal Buffett watches for is insider selling activity. Insiders are management and executives who own shares in the company. When Buffett notices insiders like the CEO start cashing out their stock, it raises a red flag. Why would an insider sell their shares if they expected the stock to keep rising? Instead, insiders sell when they believe the stock price has peaked. So Buffett pays close attention when insiders head for the exits. It's often a sign that stock has hit a top and it's time for Buffett to sell too. For example, back in 2012, Buffett began selling his massive stake in Johnson & Johnson. One reason? He noticed the Johnson's family and other insiders were selling off their shares in the company. This insider selling activity signaled to Buffett that the stock may have reached its ceiling. And in fact, after Buffett finished selling, Johnson & Johnson stock kept for the next 3 years. So take a page from Buffett's playbook and watch insider transactions. Major insider selling can be a warning that indicates a stock is tapped out. The second indicator is deteriorating fundamentals. The next factor Buffett analyzes is the underlying fundamentals of the business. He wants to see steady, increasing revenue and earnings each quarter and year. When the fundamentals start weakening and the numbers begin declining, alarm bells go off for Buffett. Often this signals that the competitive dynamics have shifted or demand is softening, and usually a weakening fundamentals will precede a decline in the stock price. For example, back in 2007, Buffett began winding down his position in U.S. Airways. He noticed flight capacity was expanding much faster than passenger traffic, signaling a supply and demand imbalance. The weakening fundamentals were a warning sign of tougher times ahead. And sure enough, over the next 2 years, U.S. Airways plunged nearly 90% as high oil prices and economic troubles affected the airline industry. Buffett read the deteriorating fundamentals correctly and got out in time. The third indicator is overvaluation. Buffett's third signal that a stock has peaked is when it becomes overvalued and disconnected from the underlying business performance. He gets worried when the stock price spikes much higher without any real improvement in the company results to justify it. This means investors are likely bidding up the stock for emotional reasons, not for fundamental reasons. And overvalued stocks always come back down to earth eventually. For example, in late 1999 and early 2000, Buffett began trimming his massive Coca-Cola stake. Coke stock had shot up over 500% in just a few years during the dot-com bubble, massively outpacing its business growth. To Buffett, Coke was wildly overpriced just because of FOMO. Within a year after Buffett sold, Coke stock came crashing back down. The key is not to get sucked in when stocks become overhyped. Rely on the fundamentals, not the hype. So there you have it, the 3 indicators Buffett uses to know when a stock has hit a peak. By watching insider activity, monitoring fundamentals, and avoiding overvaluation, you can better time your exits. Use these same signs to tell when your stocks have tapped out their growth potential. Hit the thumbs up if you found it helpful, and stay tuned for more investing wisdom coming your way soon.